Good morning, all. Thank you all for joining us for our session on retirement plan options, tax law changes, and fiduciary plan reviews. If we haven't had the opportunity to meet before, either in person or virtually, my name is Vanessa McElrath, and I'm a wealth advisor and partner in our wealth management group. And I've had the very good fortune of being with the firm for almost 8 years now, but working in investment management services for over 13. And I really consider myself lucky. I love my job and I love the opportunity that I have to educate clients every day on the science of investing and preparing for one of life's biggest chapters, which is retirement. And I'm lucky to be joined by my counterpart here, Julie Reinhardt.
Yes, thank you, Vanessa, and thank you all for joining us today. My name is again Julie Reinhardt, and I've been with ML&R since 2007, and been in the business for longer than that. So longer than I want to count. I enjoy helping our clients with setting up their plan and helping their plan stay in compliance. I work more on the third-party administrator side with our clients, and hopefully we'll have a lot of good information for you, either if you're interested in maybe setting up a plan, maybe changing your plan, or benchmarking your plan, looking at those tax loss changes that we're going to talk about today. So hopefully you'll find some interesting things here.
Great. So, I know a lot of you that are logged in today wear a lot of different hats and probably play a variety of different roles in your respective companies and organizations. And maybe just one of those roles may be as plan sponsor, administrator, or maybe just the de facto go-to person that people go to with questions when it comes to benefits and company-sponsored plans. That's certainly a lot of responsibility under normal circumstances. Throw a pandemic on top of everything, and I'm sure you guys have your plates more than full, because there's certainly been a lot to digest over the last 18 months or so. So that prompted us to put this session together. So today, to start, we'll run through some different types of plans that can be put in place by an organization for the benefit of owners and/or employees. And so, this will kind of give us a lay of the land and better understanding of different plan types, different plan options, advantages and disadvantages of each. And then there's also been some regulatory changes and different tax incentives and credits that have come out that are associated with certain types of qualified plans that have come into effect. Some of those were regulation and changes that were already in the works, and then some did come about as a result of COVID relief measures. So we'll review those, as certainly that may impact your thinking if you, impact your plan if you already have it in place, or may incentivize you to start one if that's something that you've been contemplating for some time now. And then certainly, I think, lastly, we'll wrap it up with what I call an evergreen topic, but it's so critically important, and that is on fiduciary reviews and responsibilities. So we definitely want to spend some time to give you some guidance and help on how to evaluate and monitor your retirement plan from a fiduciary perspective, to help you manage some of that fiduciary liability and risk that, as a plan sponsor, you're never going to fully be able to delegate away or rid yourself up. So we certainly do have some best practices and tips to help you kind of manage that on an ongoing basis. And then, of course, we'll reserve time at the end for Q&A, but as Sarah mentioned, feel free to use that Q&A function at the bottom of your screen as well, and we'll do certainly do our best to manage that as closely as possible. Okay. But diving in, there are, I would say, two main camps or types of different company-sponsored retirement plans. You have IRA-based plans and qualified plans. I think, most people are familiar with IRA-based plans. They're certainly the most basic. And this could include a type of plan such as an employer-sponsored IRA, a SEP plan, or what's called a simple plan. And basically with these types of plan, each individual is going to have their own account. And then once amounts are funded into those IRAs, that individual is going to have access to that money. It's fully vested just as it is in a regular IRA. Contrast that to kind of the second camp is a qualified plan, which again, many of you are likely very familiar with, where a qualified plan is a type of employer-sponsored plan that's going to qualify for special tax treatment, specifically under Section 401A of the Internal Revenue Code. And so these, qualified plans include things like 401Ks, which, most of us are familiar with, profit sharing plans, defined benefit plans. And with these types of plans, in most cases, employers are going to be able to deduct an allowable portion of pre-tax dollars from an employee's wages for investment into a kind of a pooled trust account. Now, on top of that, though, there's going to be additional kind of rules and restrictions. And it's because these qualified plans, they qualify for certain tax benefits that I would say go above and beyond what a basic IRA-based plan can typically provide. And then it's also going to have some additional, what I would say, government protections. And so because of that, these types of qualified plans, they are going to be subject to additional filing requirements with the IRS. And then they also have to meet certain ERISA guidelines and criteria. So because of all of that, they're going to be a little bit more restrictive on how participants can access the funds or take distributions from the plan. So that's just a general overview of those kind of two different buckets or camps that we're going to be focused on today. But we'll look under the hood and dive into those IRA-based plans that I mentioned here. And one of probably the most common that you will see is what's called a SEP, or a Simplified Employee Pension Plan. Many of you may have heard of it, and these are often ones that you'll often see common for self-employed individuals, but it can also be a good fit for an organization that wants to get a plan in place for the benefit of owners and or employees. And so similar to the other IRA-based plans, each participant is basically going to have their own IRA account, which is typically going to be set up directly at a custodian. So think a Schwab or a Fidelity, TD Ameritrade, or through a broker. But the biggest differentiator with a SEP type of plan is that contributions are solely and fully funded by the company. So you don't necessarily set these up to allow employees to make contributions or defer. It does all come from the employer. Now, these contributions, when the employer makes these contributions, they are discretionary. So you do get to decide year by year if you are going to make a contribution and what amounts. But it has to fall under certain limits and guidelines. So, for example, you can make a contribution of up to $57,000 a year to any single individual, but the maximum tax deductible contribution to the employer is 25% of aggregate pay. So basically, you'll see contributions they may make. An employer may make a contribution up to 25% of pay. And then it'll be capped at that $57,000 limit level. And generally, this is going to be allocated pro rata based on salary. So in other words, what that means is that you're basically putting in the same percentage of pay for all eligible individuals. So, for example, I may set up a SEP plan for my company, and then I could decide that this year, it's been a pretty good year, so I'm going to do a 10% contribution for all eligible employees. So it's uniform kind of across the board. Everyone's getting that same pay rate. So I can't necessarily go in and decide that I want to give 25% to myself, I'm going to give 10% to John, and then 20% to Sally. You know, it's got to be uniform across the board. And then there's going to be additional rules on who has to be included, who has to receive that contribution, or who is eligible. And basically, if an employee has attained, you know, if they're at least 21 and they've worked for the firm in 3 of the last 5, then they're going to be eligible to receive a contribution. So again, these are pretty easy to set up and administer, but typically bigger dollars that have to be put in on behalf of employees from the employer. But again, I think why you see these typically be popular is, again, it's very simple, easy to set up. You basically just fill out an application to set it up with the custodian, and you know, you can self-administer because they don't have any testing requirements or IRS filings. You don't necessarily need to engage a third party, like a third party administrator or a record keeper. It's pretty easy. You can just set it up yourself. And there's a lot of flexibility on timing of when they can be set up. So for example, plans typically have to be set up and funded anytime prior to the tax filing date with extensions. So for example, let's say I am running an S Corp and I filed an extension for my 2020 return. So my 2020 return is now going to be due September 15th of this year, 2021. So I technically still can decide to set up a SEP plan before September 15th and fund it for 2020 as long as I do it before that 15th deadline. So again, a lot of flexibility there. Now, the disadvantages obviously are that it's all funded with employer money and no employee contributions. And, you know, it may require pretty high contribution rates to what I would say rank and file employees or non-owners in order for the owners to be able to put in any significant contributions on their own behalf. And then furthermore, you know, anytime you fund these accounts, they're fully vested. So, you know, you could make the contribution for employee Tuesday, employee quits Wednesday, and the money is, you know, the money's theirs, it's fully vested. So that's one type of plan. Another one that you'll typically see often in IRA-based plans is what's called a SIMPLE, and that's just kind of a catchy way acronym for a savings incentive match plan for employees. So it's kind of a mouthful, and SIMPLE makes it pretty easy. But again, it's another IRA-based plan, and here, like a SEP plan, contributions are made to individual IRA accounts, but there are some more specific rules. So basically, they're only eligible for companies that have fewer than 101 employees. And then the plan must be set up by October 1st to take effect for that year. So for example, if I wanted to get a plan in place for 2021, I have to make sure to have my SIMPLE plan set up by October 1st of this year. Now, unlike a SEP plan, a SIMPLE is going to allow for both employee and employer funding. So employees can decide to make contributions, and they can decide to defer up to $13,500 for a year, or a little bit of a catch up if you're over 50. So the maximum there is $16,500. So these limits are definitely more than what an individual can put into a traditional IRA. But it's less than the threshold and limit that's allowed in kind of your standard 401k. So it kind of falls in the middle there. But then the employer must make a contribution, and they can do that kind of in 2 different ways. They can either make a contribution or do a match of 100% of pay saved up to 3%, so a dollar for dollar match up to 3%, or they can elect to give 2% 2% contributions to all eligible employees, regardless if those employees are making deferrals or contributions or not. And then there's some additional rules, you know, what what constitute an eligible employee. That would be an employee that's eligible if they at least made $5,000 in compensation in the last 2 years from the employer. So there are certain guidelines that you have to hit that would bring those employees in as eligible to receive those dollars. Now, in practice, typically what I see is employers doing that match of 3%. And then, there is a little bit of wiggle room and flexibility. So let's say an employer has a bad year financially, there is a little bit of wiggle room to lower that employer match to either 1 or 2% for a period of time. So let's say 2 years of a rolling 5-year period. But these simples, they also come, I always caution this as a caveat, they do come with some pretty hefty penalties. So basically there is a 25% penalty if funds are withdrawn within 2 years. So again, things to be aware of from that perspective. But overall, again, I think the advantages to these type of plans is they're really easy and simple to set up, particularly relative to a 401k plan, as you'll see here in a little bit. The biggest advantage here, obviously, is it allows for employee contributions, for them to make contributions and put money in. Low administrative costs and fees, and again, because you don't have to have IRS tests, compliance testing or IRS filings, you don't need to engage any third parties to help administer the plan, like a record keeper or a TPA. You can really save on those administrative costs. The disadvantages is there's going to be limited contributions, particularly for the business owners. Particularly when you're comparing that to, let's say, a SEP or a 401k, where they're going to be max capped at a lower threshold at $25,000. Other things to be aware of, there's no vesting schedule, and then it does lack some flexibility. No loans, and then it does have those mandatory employer contributions. So definitely some rules that you need to be aware of that are going to dictate what you can and cannot do. So those are really the bulk of the IRA-based plans, and qualified plans are certainly a very different beast. And Julie has seen all the ins and outs of qualified plans and all the compliance rules associated.
So we have a few questions for you. Can companies have both 401k and SEP or simple as well?
Typically, it's just one or the other. And correct me if I'm wrong, Julie, here on that one.
Yeah, it would need to be one or the other.
Yeah.
And do SEP and simple have to be funded every year?
SEP does not. The SEP is discretionary, so you can decide on a case-by-case, on a year-by-year basis if you want to make a contribution. And if you do, at what percentage. It just has to be uniform to all employees. And then a simple does typically have to be funded every year. There is that employer requirement.
All right, we will move on and talk about those more complicated qualified retirement plans. As Vanessa mentioned, and as you can see here, there is a longer, more complicated plan document. You have required, filings and testing that have to be done every year. Usually, you're going to have, additional providers, record keepers, third-party administrators, custodians, different people that are going to be involved that you're going to have to coordinate with. Opening a qualified plan or starting a qualified plan is going to bring some fiduciary responsibility and liability for the sponsor of that plan, typically the employer. You have to have those assets in a trust, but again, they're going to have some more flexible contribution options than IRA-based plans. You can set some, eligibility requirements, but there's a maximum amount of time that you can keep somebody from participating in the plan. And probably the most popular plan that you hear about in the US is the 401k plan. You can have you're really allowing the employees to take control and take the reins of their retirement because they can save from their paycheck into the retirement plan. They're going to have some limits, additional limits that are above and beyond, like that simple plan, as you can see here, and additional limits as you get closer to retirement. You can save both in a pre-tax manner, or you can save post-tax, which is also called Roth in most cases. And then you can have some additional for employer contributions that you can add on to that. You can have what we typically call a match contribution, and we see those are real common, where an employee actually has to contribute from their paycheck, and you're going to match what they put in. So you're only contributing for those people who've chosen to take money out of their paycheck. Contrast that with what we call a profit sharing or a non-elective contribution. That's going to go to people whether they have chosen to defer or contribute from their paycheck. So it might be a bigger group of people. And then you have some higher limits, that 58,000 and the 64,000, that includes the amount the employee puts in from their paycheck. But you have those additional dollars above what the employee can put in for those match or profit sharing. And then you can add a vesting schedule to your plan for most of those contributions, depending on how you structure the plan. And what a vesting schedule allows you to do is require that somebody has to work for a specific period of time in order to take those employer dollars, that match or that profit sharing that you're giving them, with them should they choose to leave your employment. And there are obviously advantages to setting up a 401k plan. The higher contribution limits, the additional flexibility that you can build into your document, the vesting schedule, you can have loans. But again, you're going to have that more complex document. You're going to have more providers you're going to have to deal with. You're going to have that fiduciary responsibility, fiduciary liability, additional costs that are associated with the testing, the 5,500, the filings that you have to do. So you have to kind of weigh those back and forth. But you can definitely see there's a lot of advantages to setting up a 401k plan. A specific type of 401k plan, which we call a safe harbor plan, is structured so that you get a pass for some of those tests that you would normally have to run in a 401k plan. But in order to get that pass, you have some required employer contributions that would be built into your document. You have a choice between whether you're going to give it to everybody, which is the non-elective, or you can give the match, which is only going to go to those people who've chosen to participate. You can have some different, levels of what kind of match you want to put in if you want to do that. But it would be built into your document. And in order to get out of that, you'd actually have to amend your document and change that. You have to have some notice requirements. You let those participants know that, you're going to be they're going to be, receiving that employer contribution if they choose to participate, or in the, for the non-elective. And you do have to 100% vest those contributions from day one. So you don't get that, pass on that, allowing them, making them work for a few years before they get to take your money with them. Now, let's say that maybe it's just you and your spouse that are working in your company. We have what we call a solo 401k plan, and it's really just designed for a company that doesn't have any employees. You can it gives you a little more flexibility than that SEP option, because you have you have the loan option available. You could have your employee portion and your employer portion, and you may have to do some filings once your dollars get to a certain amount in that plan, but they're a little bit easier to administer than a 401k plan. So you can set those up with a lot of different custodians in order to do that. Now, there are some more complicated plans that we can set up that have some more complicated testing in them. And it's actually, this cross-tested plan is allowing you to put in some higher dollars for certain individuals, benefiting maybe the owners or certain highly paid staff, which allows you to have a little bit of discrepancy in who you're benefiting. But you have to have more complicated, like I said, tests that are going to have to be run. We have an example here of kind of how that would look. In our example, our owner here, she's funded her business and she's poured money into her business for, however many years she's been running it now. And in her last years before she retires, she wants to really, start boosting up her savings. So by adding a cross-testing feature, she can do that. In her case, she's chosen to put in all of her, maximize her deferrals, including her catch-up contribution. Her staff are not, they've chosen not to put money out of their paychecks right now, but that's okay because she has that safe harbor feature in there. In her case, she did the 3%, and then she added on a very nice profit sharing. And then with the additional testing and then more advanced testing that you can do on these kinds of plans, you're looking at when, what those dollars are going to look like when someone hits retirement age. She's able to give, more of a percentage of the, contribution to herself than she is to the staff, and put away some really nice dollars. And these types of plans, cash balance plans, have actually been around for a while, but they're becoming more popular and more talked about in the last, 10 years or so. And it's really taking what we call a defined benefit plan and making it look like and feel like a defined contribution plan. It's going to look a lot like a 401k plan to your staff, except it's all employer funded. So you don't have any employee contributions going in. Everything is going, coming from the employer side. But with those, you have some much higher contribution limits that you can, expanded limits that you can use with a cash balance type of plan. And you can combine those, which is also really nice, with the 401k plan, and maybe even fully fund both of those. You get the cash balance feature plan, you can put in your 401k contribution, and you can have your profit sharing and safe harbor contributions. The testing, of course, when you get involved in that, is a lot more complex than even the cross testing or the regular 401k plan testing. You would end up, in this case, filing two 5500s. You'd have several different people, record keepers, administrators, actuaries, all working on your plan. So it gets a lot more complicated the more layers that you add to this. And then cash balance plans are required contribution, so it's not anything that you can be flexible about. Once you've set it up, it's it's going to be a lot harder to change. When we look at how those would work in conjunction together, let's go back to our owner that we had a few slides ago, and she really wants to sock away more dollars for herself. And in this case, she still has her, maximized deferrals that she's putting in. She has her profit sharing and safe harbor that are going into her account, and the safe harbor that's going to the staff. And then she has this very large cash balance contribution and minimal dollars for the cash balance plan because those guys are so much younger than her. And with that, more advanced testing, that can pass, and those dollars, she can get some really nice dollars going into her account over those last few years as she's preparing to retire and possibly sell her business. So kind of putting all that together, when does an IRA-based plan make sense? When does a qualified plan make sense? So if if you're a small company, you want to put all of those dollars in from the employer side, you don't really want all those other providers, you don't want all that other headache, the SEPA, the Simple, might be a better fit for you at that time. But if you can take on that additional fiduciary responsibility, you can get yourself with some good providers that can help kind of coordinate those and keep that complexity under control. A 401k plan, a qualified plan, might be a better fit, especially as you grow. You can set them up simply, or small with the basic features, and then start adding those things and making them more complex as you expand your business and as you go throughout. The plan needs to evolve with your company as it's growing. So, maybe you don't have the cross-tested feature at the first, but then you maybe want to add that later. And then, as you get in, to, if you're having some, guaranteed, income, really consistent profits, and you want to sock away, six-figure tax deductions into your account, then that's when you want to move into that cash balance feature. So that's kind of closing out our discussion about IRA plans and qualified plans. And we want to put up now a polling question. This will be our first polling question. And so if you guys can respond to that, we're looking at what is the maximum deferral for a 401k plan for somebody who's under age 50 during 2021. So just a few more minutes here. Remember, all those plans have different limits. Simples, 401k plans. We'll see how many people remember this one. And I think we can put up the response now. Looks like everybody got that right. Of course, those people who are not yet 50, they can't put in that catch-up contribution. And that $19,500 is the max that they can put in. Once you hit age 50, whether you hit age 50 in November or whether you hit age 50 in February, you can put in that additional catch-up. In this case, for 2021, that amount was $26,000. So that was our first answer. And those other two limits have to do with different types of plans. So good job. All right, our next section, we're going to talk about some recent and proposed legislation that's going on in Congress right now over the last few years, and then again perspective. And some of that's going to be, we're going to talk about those tax credits for sure, and then we're going to talk about some other features just to make sure that they have hit your radar screen, hopefully so. So the Secure Act was probably one of the biggest packages to hit retirement plans in the past few years. We're going to talk about, again, some of the highlights. One of the first ones we're going to talk about, of course, is the tax credit. We are allowed now to take some increased tax credits for startup expenses, plan administrative costs, participant education. It's a little bit complex. It's 50% of the cost of $250 times the number of non-highly compensated persons, or $5,000 if your amount is higher than that. So just talk about a non-highly compensated person. A non-highly person is generally someone who is not a 5% owner, they're not related to a 5% owner, and they made less than a certain dollar amount in the prior year. So let's say in your case, you counted up your number of people and you had 25 people that fell into that category. They're not owners, not related to owners, they made under a certain dollar threshold. So you would calculate that as $250 times 25, then you'd take 50% of that, which works out to be a little over $3,000. So 3,000 is less than 5,000, so your tax credit would be $3,125 in this case. And you get to take that tax credit for the first 3 years of your plan. So those are some nice, additional benefits for starting a plan. So if you haven't started a plan, this is a great time to consider starting one. The other nice little tax credit, it's small, but it's still nice that they're, working these in, is for setting up automatic enrollment on your plan. In case you don't know what automatic enrollment is, this is a feature that's built into your plan where everybody is automatically set up to start contributing from their paycheck. They're not opting in, they're opting out. And you might set that rate at 3% or 5%. So from the first moment they're eligible, they're going to be contributing from their paycheck, whatever you've decided in your plan document, 3%, 5%, 6%, whatever that number is. If they don't want to participate, they actually have to go into your system, fill out a form, whatever your plan is doing, and opt out of the plan. So Congress felt like this was really important, so they built this in and wanted to give people some incentive to do that. This actually applies not only to new startup plans, but you can actually add this to an existing plan and get that $500 credit for the next 3 years if you don't already have that in your plan. So think about those. One of the other big things that came from the Secure Act was the requirement for long-term part-time employees to be able to participate. So right now you might have in your document where they have to work for a certain period of time, accumulate a certain number of hours before somebody can participate in your plan. And you know, let's say maybe you have to work for 12 months and you have to work 1,000 hours, and you have somebody that's working for you and they only work about 500 hours a year. You could keep that. Your document could keep them from participating in your plan until they actually become a full-time employee and they hit that 1,000 hours mark that you set in your document. But the Secure Act is saying that if you have somebody that's consistently working 500 hours or more for you, you have to allow them to participate. And that doesn't mean you have to allow them to receive the match or the profit sharing that you might be giving them, but you do have to allow them to start saving for their retirement. So starting with 2021, we have to start tracking those people and see if for 3 years in a row, if somebody's hit that 500 hours mark. And if they have, then the next year they would have to be allowed to participate. So it may not affect your plan if you already, you know, are letting people in and they only have to work, you know, 3 months, you don't have an hours requirement at all, they may already be participating in your plan. So it's very important for you when you're sending your information to your record keeper, your TPA, whoever it is that you're working with, you're sending them full census data. Everybody that works for you, whether you think they might be eligible or not. That way they can start looking at those and make sure that you're in compliance with this as this law comes into, you know, play in the next few years. The Secure Act also had a few other changes. You don't have, for some of those safe harbor, you know, plans, you don't have to send a notice anymore. It's still probably advantageous for you to continue sending a notice. So that one was kind of a hit or miss for me. Lifetime income calculations are going to have to start appearing on participant statements next year in 2022. And I know all the record keepers that we're in contact with, they're working with their software providers to make sure that, you know, they're all, you know, ready to go, but you want to make sure that you watch for that and that you've talked to your providers and make sure that that is, you know, set to be on those statements in 2022. You're allowed to add in some qualified birth and adoption distributions. Those are optional. You don't have to allow that, but that is an additional feature you can add into your document. And then they did increase the date that somebody has to start taking money out. So the IRS says at some point you have to start taking money out of your plan. That age was previously 70 and a half. It has been raised to age 72 starting for in 2020. The CARES Act, this was a law change that kind of happened all last year and is over at this point, but you could have added in some additional loan and distribution options, you know, some expanded payment options. It only was, you know, affected people that actually had COVID-19 or taking care of someone that, you know, had COVID-19, quarantined for COVID-19. So there were very specific requirements of when somebody could use this. They were all optional. They've all expired now, but you need to have a record of what you did. Did you allow for these? Did you not allow for these? So that when your documents are restated, that you have all of that information in there. And in theory, your record keeper, your TPA, somebody should be keeping track of that, but you should know that as well as a plan sponsor. And then our proposed legislation. So this is all being talked about in Congress right now. We don't know exactly what's, of course, going to pass both houses of Congress if it all does go through. But these are some, you know, kind of more of the notable things that they're considering. They're actually talking about expanding some of those tax credits for starting plans. So we're talking about small plans here. So plans that would have less than 50 people in them. You could actually take 100% of that cost as a tax credit. And then that would be staggered out over the next 3 years. There are some caps in there too, but you know, that's just to incentivize people to start those plans. One other nice perk is they're talking about increasing that. Remember they just changed it from 70 and a half to 72, and now they're talking about changing it again to 75. That would be the age that people are required to start taking money out of the plan. And then we have that catch-up option that is, you know, right now is 6,500, and we're talking about adding another catch-up option for people. So increasing that from 6,500 to 10,000 once you hit age 62. So from 62 to 64, giving people a little more that they can put into their retirement plan, which would be really great and help people as they near retirement. And then there's been a lot of talk about student loans and student loan debt in the past few years. They're actually talking about allowing people to write this in their document. There's been some where people have applied and received what they call private letter rulings or approval, but it's just for that particular company, and they're actually starting, you know, talking about rolling this out to more people. And that would allow, you know, employers to help when they know somebody's paying off student loan debt, and they could, you know, if the person's paying off their student loans, they could match them, but match them in the retirement plan, so that, you know, maybe they're not participating in the retirement plan right now because they're paying off their debt, and that would allow the employer to put money in for them to kind of help them get started on that retirement path too, so that they're not behind. So we'll see how it all shakes out. It, you know, none of this may come to fruition. It could be all something totally different, but we felt like these were some of the more notable things, and we wanted to point those out, that, you know, those are the ones being talked about, and we'll keep our eye on those. And I think that brings us to the end of our second section, and we're going to have another polling question up here. And we want to talk about what's the tax credit for adding automatic enrollment feature to a retirement plan. Remember, this is where you're, you know, opting everybody in rather than opting everybody out. You can add this in for existing plans. You can add this to a new plan, and you're going to get a tax credit for a certain number of years. And let's see if anybody can remember what those credits are. Is it 1,000? Is it 500? Was it 2 years, or was it 3 years? We'll give everybody a couple more minutes just to respond. No grades are taken here, so just give it your best guess. All right, so if we want to put the results up and close that poll out, and looks like it was 500 for 3 years, 500 for 2 years, 1,000 for 2 years, and 1,000 for 3 years. So 30% of you, looks like here, got it right. And now we're going to move on to talk about the fiduciary review of your retirement plan. And I'm going to turn it back over to Vanessa to finish out this last section and see what questions you guys have.
Yeah, thanks, Julie. You know, I do want to spend some time on fiduciary review because I always liken it to getting your annual physical or checkup. You know, you go to the doctor, you have an expert kind of run tests, look at your vitals and see, you know, how are you doing? Are there any areas of improvement? Are there any issues that you should be aware of? And it's a very similar type of exercise with your company-sponsored retirement plan. And one, it's to help you as a fiduciary to the plan, manage the plan, but also just to make sure, you know, is the plan doing what you had intended? You're investing a lot of time, money, and resources to administer and maintain a qualified plan, so you might as well make sure that it, again, is achieving your goals. So, you know, I think there's some kind of overarching questions that you want to consider or review when you're doing your annual checkup and fiduciary review as a plan sponsor. So I think there's some questions like, you know, our current participation levels, where they are, you know, what are they and how do they stack up compared to what you would want them to be? Do you know the total fees associated with your plan? How did your last audit go? Are owners or key employees receiving refunds or having their contributions limited? Is plan design optimized to enhance participant outcomes through vesting or matching? You know, when was the last educational meeting for your employees? You know, these are types of questions that I think are very helpful in identifying any potential red flags, so issues that should be immediately addressed, or perhaps maybe, you know, areas that stand for a little bit of improvement, room for improvement at the very least. And so hopefully this can kind of help frame that assessment for you on areas to focus on and tackle. All right. So, and I think it's important, there's kind of 3 key areas: examining plan design, examine the investments, but also examining kind of overall and costs. But it's important to start with plan design because, again, it's, you know, thinking about, is your plan designed with your goals in mind? And is it designed and structured to help you achieve those goals? You know, for one, if you're an owner, is it meeting your needs? Perhaps you're trying to capitalize and save for retirement, and examining that. What about for the employees? Is it really a true benefit for them? Are they using it? Is it competitive enough? You know, we're obviously in a very tight labor market right now, and so a lot of the conversations we're having with employees and plan sponsors, excuse me, is how do we restructure the plan to make it more competitive? And folks are asking, you know, are we in line with kind of similar plans of similar size in terms of assets and participants and employee demographics and industry? Where are areas where we could really boost benefits? So that's certainly an area of opportunity where you can take a look at the plan design, because really it shouldn't stay static. You know, the plan design may change as your business matures, or if you go through different life or business cycles and as your employee demographics change. So that's why it's always helpful to go back and review that. And I think ideally you should have an engaged investment advisor, if you're working with a fiduciary or maybe a third-party administrator, that's going to help you spearhead these conversations periodically and help make recommendations or adjustments to the overall plan. Because I think there's some very key things that you should keep in mind. You know, if your goal is to reduce refunds, you could look at alternative plan designs to include safe harbor. If your goal is to increase participation, perhaps you look at adding a match, or enhancing the match, or instituting auto enrollment, and even getting some of those credits that are now available. Or perhaps your goal is to increase contributions to the owner. So maybe it's looking at cross-testing or cash balance options. So, you know, these are areas where you want to be, you know, really think about it critically, be proactive, and be strategic. You know, there's a couple of examples I've included here of cases where we did a fiduciary review for a company, and there was one firm in particular where we really examined plan design. And in this case study, you know, the company, they had already a basic plan with profit sharing and match in place. And very typical, unfortunately, they had an investment advisor that helped them put the plan together, sold the plan, but then afterwards they kind of disappeared. So really wasn't providing any ongoing education to participants or ongoing recommendations from a plan design perspective to the plan sponsor. They just kind of set it up and then went away. So we were able to come in to help, you know, the owners. They really wanted to increase contributions for themselves. So we changed the plan to allow for cross-testing and profit sharing. This allowed the owners to put in extra benefits to the owners, which no one had told them was an option before. And then started working with the employees. So doing more kind of put together an education plan. So we had ongoing education, which ended up just boosting employee morale, because then they actually understood the plan and the benefits that was being provided to them. And from that, we saw that participation went up from 85% to 95%. Deferral rates actually went up. And all of this actually happened by even reducing overall costs. So it was helpful for the plan sponsor just to go through this whole benchmarking process and assessment to determine, can we actually improve the plan and actually reduce costs? And in this case, we were. So it was kind of a win-win on all fronts. On another, that was really focused on plan design. I think you also want to take a close look at the analysis of the investments. So are you giving your participants the right tools or building blocks so that they can have a successful investment experience? And so contrary to what a lot of folks might believe, this doesn't mean finding 5-star or gold star rated funds or comprising your 401k menu of Money Magazine's fund recommendations, for 2021. That's actually leads to, I would say, suboptimal outcomes. What you want to do is, again, engage a fiduciary investment advisor. So that's one who's legally required to act in your best interest and participants' best interest to come up with what I would say is a disciplined and measurable process to select and then periodically monitor and evaluate funds. And this criterion process, it should be centered around a sensible approach to investing and one that's rooted in academic evidence. So, and focusing on the elements of investing that you actually can control. So, making sure that fees and turnover is low for the funds that are in investment options that are available in your plan. That you have investment options with proven track records and tenure. Investment options that are sufficiently diversified. So not only within each fund or option, but also that you're providing diversified asset class coverage so that they have enough tools or building blocks so that they can build a globally diversified portfolio. And then ideally, you're also offering up a single choice option. So for instance, a lot of folks don't necessarily know how to put individual investments together to build a robust plan. So they may need a little bit more guidance or help. And that can be done effectively through risk-based model portfolios, so professionally managed models, or through target date funds. So this is just going to give those participants who aren't as hands-on but want some professional management or guidance on how those underlying investments should be put together. And similarly, we recently did a plan review where it really focused on the investment component. So these funds in this particular plan that we looked at had really high expenses, poor performance track records, and they scored low in key fiduciary benchmarks. So they had high expenses, high turnover, lack diversification. The plan had 63 different investment options, which actually is just, it's too much. That's overwhelming for participants. So we worked to help curate that a little bit. Some other issues that we found were, it was a really convoluted revenue structure. So the advisor that sold the plan was getting commissions off some of the investments. So then you had to question, well, were these investment options truly in participants' best interest, or was there some potential conflict of interest? So we were able to look and get, by doing a review where we designed a transparent open architecture fund lineup. We provided those model portfolios, reduced investment costs, reduced total plan cost, and then put together an education plan that consisted of enrollment meetings, general education and financial wellness, but also one-on-one meetings with interested employees. And what we saw is participation, particularly overall, and then in the models increased. And so these are just some kind of key things to be aware from an investment perspective. The last piece, and part of your fiduciary responsibility too, is to actually know what you're paying. And unfortunately, the retirement industry makes it really hard because a lot of plans will have these convoluted revenue sharing arrangement where your different service providers, whether it's the advisor or the third-party administrator or the record keeper, they may be getting compensated by some of the fund options through commissions, and it makes it really hard for you to do your job as a fiduciary to evaluate, are my service providers doing what they said that they would be doing, and is it commensurate with the level of fees that they're receiving? And so again, it can be really hard, but this is one area where we can come in and help, is by doing a complementary plan review where we look at all of these different areas, where we look at the plan design, we look at the underlying investments, and then we look at the fee disclosures and really try to disentangle, okay, what is the amount that's getting paid to each service provider, and how does that stack up to plans that are similar in terms of size of assets and number of participants. You know, are your fees above average? Are they below average? Are they kind of in line with industry? And that can help you evaluate from your fiduciary perspective, are my service providers doing what they said they would be doing? And again, is it commensurate with the level of fees that they're receiving? And again, that's part of your ongoing fiduciary responsibility. And something that we can help with is doing a complementary plan review where we focus in on those 3 key areas and can at least provide recommendations or identify key areas where there's room for improvement. And that's something that I think all plans should do, perhaps even once every couple of years or so, you know, if not every year, for certainly every other year, just to get, again, kind of an assessment. How's your plan doing? Is it in line with industry standards and benchmarks? And are there ways to improve it? Because again, as a fiduciary, that's part of your role and responsibilities. So I'll take a brief pause right there. It is 11:45, and I know we wanted to be cognizant of time. I haven't seen any additional questions come up, but if folks have any questions or want to submit them now, we can certainly make sure to address those. Otherwise, I do want to pull up our last polling question too, in case someone does need to hop off now.
And I think we're wrapping up. It's 11:45. So Vanessa, did y'all have anything else y'all wanted to say kind of in closing?
No, I just want to make sure we get our last polling question out.
Right. We'll leave that up.
But otherwise, we do, while that comes up, we do have our contact information here. I've included mine as well as Julie's. So if you have questions about setting up a plan, some plan design issues, or interested in getting a complimentary review and benchmarking assessment, that is something our team is capable and eager to help with. Okay, so we have our last polling question here that has come up. And the question is, when was the last time you had a fiduciary review of your plan to include the plan design, investments, and fees?
Yeah, and it looks like it's been answered and taken down now.
Okay.
I think we're good.
Okay. All right.
All right. Thank you so much for joining us, everyone. Sorry we couldn't see you in person, hopefully next year, but everyone take care and contact anyone you would like to. The panelists would love to talk further about their respective presentations. So thanks, everyone. Have a great day.
Thank you.
Bye.